The tax law rewards producers and taxes consumers. We think of sales taxes, consumption taxes, not income taxes, but income taxes really are consumption tax because as long as you put your money back into productive uses and don't consume it, you won't pay tax on it. That's the great thing is it doesn't matter if you're a small investor or a big investor, anybody can be an investor in this country.
As long as you are playing in the asset and the capital economy, you have options and it's not going to be a concern. If you make a really high income, you're like, I'm $1 million earner because I'm a surgeon, then you need to move and play in that world so you can get deductions and everything to offset, or you're going to lose 50% of your income.
The more money you make, the more tax you pay, but the more wealth you build, the less tax you pay.
Tom Wheelwright, thank you for coming on. You almost don't need an intro. You're a legend in the investing world in the real estate space. Your books are amazing. Tax-Free Wealth. I read that a long time ago, and it really changed my perception on taxes, wealth, what the tax code is even set up to be, how it works. And I think especially right now in the United States, that is probably one of the largest misunderstandings out there is taxes. You can hear it in the public discourse. So thank you for coming on. I have so many questions and I look forward to picking your brain.
Well, I'm looking forward to being here, AJ. It's actually an honor to be with you and your listeners.
Wonderful. Well, I want to start this whole conversation off. You reframe the tax code just in general and how people should think about the tax code. And you've talked a lot about this, like what is the purpose of the tax code and how does it work? Could we start there? And then that can lead us into everything else, but get a foundation.
Yeah, absolutely. So most people think the tax law is there to raise revenue for the government, and that's what they think. And it is. It's part of the reason. But if you look at the tax law, there's about 6,000 pages plus of tax code. And there's 30 pages of that actually raises revenue. It tells you how much tax to pay, whether if you're married or if you're single, all the rate tables, all that kind of stuff. But there's one line that says all income's taxable unless we say it isn't. Another line that says nothing's deductible unless we say it is. But the other 5,970 plus pages are really just a guide for reducing your taxes. We would not need them. If it was only to raise taxes, it'd be almost a pamphlet, the tax law would be. The reason it's as complicated as it is because the government provides certain incentives to take certain actions, particularly in how you invest your money or how you make your money. And as a result, really, once you understand the tax law, you really get to choose how much tax you pay. And to me, that's the big aha I hope everybody gets is they're choosing how much tax to pay based on how they make their money and what they do with their money.
That is such a reversal in thinking for most people. I mean, that number is staggering, right? And I think that people assume such a basic level, no, we have to pay this much, and they don't understand it all. And I think a lot of it is because we're so distant from it. W-2 income earners.
Sure.
Okay, you paid your taxes, it's pre-tax, you get it, and that's what's left over. And that's how the tax code works, but it's really, really not. So when you are a entrepreneur and a business owner or an investor in real estate, how does the tax code, I think of it as there's two different economies. You have an income economy and you have a capital asset, right, type economy.
True.
How different is that what you can do, your abilities and everything from just a W-2 job?
Well, think about it this way, that the tax law rewards producers and taxes consumers. Our tax law, AJ, has actually become practically a consumption tax. We think of sales taxes, consumption taxes, not income taxes, but income taxes really are consumption tax because as long as you put your money back into productive uses and don't consume it, you won't pay tax on it. And so what happens is that in today's tax law, it doesn't matter if you're spending it for deductions in your business or whether you're actually buying assets like real estate. And real estate, of course, we do have a real estate president. So that has had a major impact. I mean, we had one back in 1980 his name was Ronald Reagan. And he was as much in favor of real estate and tax deductions for real estate as the current president. And so we got a lot of our initial tax incentives under Ronald Reagan. What Donald Trump and Congress has done under the Trump administrations, both administrations, has to make massive increases to the incentives. And the biggest one, of course, is bonus depreciation, which was just made permanent in 2025, where anything that you invest in, any production, whether it's real estate or manufacturing, whatever, if it has a useful life of less than 20 years, you get to write it off immediately. Well, if you think about it with real estate, the great thing about real estate is we get to leverage real estate. In fact, we're crazy if we don't leverage real estate because that's where half of the returns come from the leverage, right? And so what people, I think, often forget is that while you're leveraging your return, you're also leveraging your tax benefits because your tax benefits are based on the purchase price, not how much you invested. So the banks don't get any tax benefits for putting their money into the real estate. You as the investor get all the tax benefits because in the end, you're on the hook, right, for the debt as well as for the money you put in. So you get all the tax benefits. So if you have an 80% loan to value as an example, which is a typical mortgage, right, then you're getting 5 times the tax benefit as if you just put in your own money. So, when I hear people talk about they don't believe in debt, I'm just going, well, then you don't understand real estate if you don't believe in debt.
You don't understand the economy. I mean, the economy is debt. Money is debt.
It is. Money is debt.
Yeah, it's how it works.
That is one of the favorite lines my friend Robert Kiyosaki goes, you know what? Money is just debt. That's all it is anymore. There's no there. There's no gold backing it. No. It's backed by consumer confidence. That's what it's backed by. And so, and in effect, it is debt. And that's why we run $1 trillion deficits.
Yep, exactly. Now, speaking of that, one of the things that we've been working, my firm and working with investors in our investments, our real estate portfolio, everything we're looking at, is we are preparing and trying to prepare people for tax increases in the coming years as we look at the landscape and assume that over the next 10 years, there will most likely be tax increases. Is that a worldview that you share?
We are in a fairly low tax situation in this country versus other countries, but we're not low compared to historically. I know people like to go back to the 1970s when we had a 70% tax rate, but I was actually practicing back in the late 1970s. Nobody paid a 70% tax rate.
No.
I mean, we'd call that a stupid tax, right? You just didn't know what you were doing. There were way more tax shelters, way more tax benefits back then. And Ronald Reagan, when he reduced the rates and flattened the tax base, he also got rid of a lot of the tax benefits that were there prior to him. And so while he did reduce the rates, he reduced them at one point all the way down to 28%. And so we're going, well, we have 37%. Could it go up to 45%? Yeah, it could. The reality is we don't have a 37% tax rate. We have a 41% tax rate because we have this net investment income tax, 3.8%. So there's no real, the cap is not what people think it is. We really are at that 40% rate. So once you look at that, you go, could it go to 50%? Yeah, it could. We thought that might happen under the Biden administration. And if it were not for my senator, Kyrsten Sinema, and Joe Manchin, we probably would have had a massive tax increase. We had a pretty big tax increase as it was, but we would have had a massive tax increase had it not been for literally just 2 senators. And so the chances of that happening again, pretty good. And could we get more tax increases? Yes. Will we ever lose the ability to reduce those taxes by doing what the government tells us to do? No. It'll just be different things.
Exactly. When we say we're preparing for is that they're going to do things to increase what you talked about, just that overall tax. We may do it, but then the tax shelters and the tax deductions and everything will still be in place. We don't believe those are going along. So it's like, how are you incorporating that into your investment thesis and looking out? If I'm looking at a 10, 15-year time frame, because when you take your money out is really dependent on the tax landscape.
Yeah. So let me share a little perspective. Joe Biden was very clear that he didn't want people making under $400,000 to pay more tax. I think that's a pretty good number. If you look at the 2025 legislation, $400,000 is a level that even the Republicans went with. What does that mean? Well, keep your income under $400,000. That's all that means. And with investing properly, you can keep your income under $400,000. So as long as you're doing the planning, you don't really care what the upper tax rates are, as long as you're investing and you have a really good tax advisor, a good attorney, good team, to work with. As long as you have that and you're well educated, why are you paying a lot of taxes? Like when we work with a client, either my firm or one of our franchisees, our target right off the bat is get to the 20% tax rate. Well, you're under 400,000 at a 20% tax rate. That's where we want to go. So I'm less concerned. I mean, yes, okay. So under Biden, we had energy credits versus, the big real estate tax benefits. I mean, it's just the benefits are going to be there because government always wants to incentivize and encourage certain activities.
Exactly. And I think that's the root of it. As long as you are playing in the asset and the capital economy,
Right.
then you have options and it's not going to be a concern. If you make a really high income, you're like, I'm $1 million earner because I'm a surgeon, right? Then you need to move and play in that world so you can get deductions and everything to offset, or you're going to lose 50% of your income.
Yeah. One way I like to look at this is the more money you make, the more tax you pay, but the more wealth you build, the less tax you pay.
Exactly.
So wealth is assets, right?
Yes.
Money working for you. Income is earnings. I think earnings will long be highly taxed. I just do. Now we might get to a point where we have $150,000 standard deduction. We may. I would, frankly, from a policy standpoint, there's some good policy behind that. But that doesn't mean if you're a high earner, I just think you're going to pay a lot of taxes unless you set up your affairs so that you're also an investor. So that's the nice thing about, if you think about Robert Kiyosaki's cash flow quadrant, ESBI, right? Employee, self-employed, big business, and investor. It's really hard to become a big business owner. That's a really hard thing to do. That's the unicorns they talk about in the tech world, right? But going to an investor, anybody can do that. That's the great thing is it doesn't matter if you're a small investor or a big investor, anybody can be an investor in this country.
Exactly. And it's so prevalent, and it's become even more prevalent with fractional ownership. I mean, what has changed with everything from the syndication laws to crowdfunding and the amount that you can use to invest and invest with operators, other people to do it, and still get the benefits from it. It's actually shocking to me how available it is today compared to 20 years ago.
Yeah, and just wait until you have blockchain ownership so that you have fractional ownership of very small fractions, not 1% or 2%, but 0.0001%, like we have ownership in Apple, right? Except for Warren Buffett, nobody has 1% ownership of Apple, right? People have 0.0001% ownership of Apple because they have a few shares of stock. That's coming for hard assets as well. Blockchain allows that. And to fractionalize hard assets is really not that difficult. I think we're going to see more and more of it in the future.
I completely agree. And I think that's the right move, right? I think about this with everything. The idea of, if you want the economy to do good, you need more people to participate, plain and simple, right? You want capitalism to work. That is by people participating in capitalism, to actually have something on the line, to know that they're this overweighted to the solely income world that we've gotten in, which is wildly different than it was, 80 years ago, 100 years ago, where the vast majority of people were owners, asset owners, farms, land, right, everything else. But it's created this massive divide. And we want people to have skin in the game, to the system. We want people to get in there more. The Trump administration just rolled out, and I'm asking this because I don't know a lot about it, the savings account or the investment account for
Oh, the
individuals.
Trump account?
Yeah, the Trump
The Trump
account. That's
accounts?
right.
They're for kids. They're for kids under age of 18.
Yeah.
And anybody can fund up to $5,000 a year into these accounts. It doesn't have to be the parents. The parents have to set them up, but anybody can fund it. And for any child born in 2025, the government's going to fund $1,000. Now, right off the bat, you have to do that by April 15th. The parents have to set that up on their tax return. They have to make an election, check the box. And then that money's supposed to come in this summer. So the Trump accounts, here's where investing always gets interesting, because in the end, so far, Wall Street always comes out the big winner. And Wall Street came out the big winner in the Trump accounts. Originally, the Trump accounts, when they were first proposed, they could invest in anything. When the bill was finally passed, they could only invest in the stock market. So Wall Street, once again, threw its weight behind it. When it was first proposed, Trump accounts could be used to start a business. They could be used to buy your first home. Now they can only be used for education. So you can see where the lobbying is. It's the higher education. It's Wall Street. That's what's going on. So it'll be interesting to see. I think once Wall Street figures out how to democratize real estate and other commodities, then I think you'll see them embrace it. But until then, they're going to fight it. And they're going to say, no, we just want you to give us your money, because that way we can make more money.
Yep. That's fascinating. So now walk me through today. I'm a W-2 earner, but I also maybe am an investor, or I'm trying to invest in. What are the things that in today's age will give me the most bang for my buck, where I should be looking for risk-adjusted type returns, but I can offset? A lot of people are saying, I want to offset. No matter how much they pay in taxes, I want to offset.
Yeah.
So what are the strategies in today's world and looking forward that we should be applying and people should be looking into to create wealth, but at the same time, reduce our biggest liability, which is taxes?
Well, I always say that there are 7 investments the government will pay you to make, and I'll give you a couple of them. The first is business. It doesn't matter if you're in the US or any other country. Business has the best tax breaks, right? You buy a car for your business, you get a tax deduction. You buy a building for your business, you get a tax deduction. You hire employees for your business, you get a tax deduction. Some employees, you actually get a tax credit, which is a dollar for dollar write-off. You develop technology, you get a tax credit, right? As well as a tax deduction. So business is number one. I would say next to business, probably real estate. The big benefit for real estate is the leverage, right? It's easier to leverage real estate than any other asset class. And that's really why real estate ends up with the bigger tax benefits. You know, if you look at it on its face, fossil fuel energy would have the biggest tax write-offs, but that's harder to leverage because it's a riskier business. And you have to understand that it's a risky business, right? First of all, is there actual oil there? Can you pull it out? What's the price going to be? Are the people you're working with, are they going to steal your money? I mean, there's all sorts of negatives. I invest in oil besides real estate, but I understand oil. I spent 45 years learning the oil and gas industry. So I'm comfortable with that. And I get a check every month, from my oil investments. But remember, the big difference, I think, between fossil fuels and real estate is that fossil fuels, you're selling your asset.
Yeah.
So you actually get a deduction called depletion because you're depleting your asset. Every single year, every time you sell a barrel of oil, you're depleting your asset. Whereas with real estate, while it does wear out, to say it doesn't wear out is ridiculous. I mean, anybody who's owned any kind of real estate knows that the carpet wears out, you have to repaint, the HVAC wears out. I mean, everything, right? And styles change. So it may even be that they're not worn out at all. You just have to completely revamp everything because the style has changed. What's going on in decor. If it's a home, for example, you can't rent it unless it's got a certain paint configuration. But one of the cool things in real estate that's really been hot for the last few years is short-term rentals like VRBO and Airbnb. And one of the reasons for that is actually a tax incentive. People call it a loophole, but it's not. It's intentional. You're not skirting anything, but you don't have the real estate professional rules to deal with a short-term rental because it's not considered a rental. Okay, it's short-term. Under 7 days if 7 days or under is your average rental period, then you have to still be a material participant. You have to be active in the real estate, but you don't have to be a real estate professional. 750 hours and more time than your other jobs. But if you or your spouse can be a real estate professional, then long-term rentals, including syndications, can provide tremendous tax benefits today. And you don't have to do alternative planning. Now, I'm going to say something that if you have another guest on here that's a tax professional, they're not going to tell you, which is I think just about anybody should be able to deduct their real estate losses immediately. Just because they're passive doesn't mean they're not deductible. It means they're passive and deductible against passive income. But most people, if they understood how to do it, could actually create passive income to be offset by those passive losses. So everybody's focused on, I've got to be a real estate professional. If I'm not going to get my tax benefits. I think that's false. And I think it's a little lazy of tax professionals who won't go through the work to actually help their clients get the tax deductions now instead of having to wait for when the property is sold.
And how do you suggest them doing that?
Oh, there's all sorts of ways. If your income comes from a W-2, then one of you needs to be a real estate professional, okay? Or you need to do short-term rentals, okay? That's it. W-2 is the least beneficial way to make money in this country from a tax standpoint. But if you own a business and your money's coming through a business, it's not that hard to turn your business from an active income to passive income. That can be done through how much time you spend at it, can be done through who you have work at it, can be done through who you have own the business. So there's, some of it is structuring, some of it is just planning. And the reality is, people talk about, well, I'm just so active in my business. I spend 80 hours a week in my business. I'm going, why? You would make more money if you spent 10 hours a week in your business than if you spent 80 hours a week in your business. Do it yourself. 3 most expensive words in the English language. Why are you doing that? You'll make so much more money if you build a team than if you do it yourself.
Yes. Absolutely. In fact, too, not just it makes so much more money, it would be safer. Most entrepreneurs are the biggest liability and they are the biggest choke point in their business. Universally, not most, all of them.
For sure.
All of them, right? There's a time and a place for that when you're in startup, everything else. The problem is entrepreneurs don't leave it.
Yeah.
They stay in it and then they can't figure out why their business is growing. And it's like, it's because of you. It's a hard thing for entrepreneurs to move out of. Now, when I've got my tax deductions, I'm looking to invest, right? I say this all the time, right? CPAs, accountants are just like doctors. You have generalists, right? You have surgeons, and I love my family doctor. I'm not going to go have them cut open my head and do brain surgery though on me. So when somebody is looking for help, when they're saying, this mistake is so universal by investors. I use my brother who does tax filings, and I ask him questions, or my brother-in-law, to do how to get rid of taxes, investments, right? And I'm like, that's the worst thing you could do. We talk about having a team, but the quality of the team is what matters. How do you know? A lot of people are like, what should I ask? How do I even know who that person is?
That is the most common question I get, AJ, as I travel. And so I actually put it into chapter 23 of my book, Tax Free Wealth, How to Find a Great Tax Advisor. At the very end, I put a checklist. Actually, there are 2 checklists. The first checklist is what questions you should ask a CPA you're interviewing. The second checklist is way more important. It's what questions they should be asking you. Because the job of an advisor is to ask you the right questions. This is why you need an advisor in the first place. If you knew what questions to ask, you could just use AI. You would never need a tax advisor, but you don't know what questions to ask. And so you ask AI and then you get a wrong answer and you go, what's the matter? I don't know. I thought AI knew everything. Yes, but you didn't know the question to ask. You ask a stupid question, you get a stupid answer. I'm sorry, but I'm just being blunt. That's how it works. A professional's job is to ask a question. You think about, okay, so we've all watched movies and TV shows about good attorneys, right? Lincoln Lawyer as an example, right? Okay, so you read this book, you watch this movie, you go, wow, man, look at that guy asking those questions to that witness on the stand. Okay, well, what's their job? Their job is to ask the right question. That is their job. That is their sole job, is to ask the right question. That is my job as a tax advisor, to ask the right question. So my point is if you have to be the one always asking questions of your tax advisor, you need a new tax advisor. And if you think that you know enough to ask the right question, go use AI and you will pay a lot of tax and you have all sorts of problems with the IRS. That is your worst teammate when it comes to taxes, is AI.
I'm going to put this into perspective. In my businesses that were sales business things before, we had an account that we'd use as we were building it. When we switched to the account in the first year, they saved us $600,000. Think about that. At that point, the cost increase of that CPA versus, it was so irrelevant. It's not even funny, right?
My guess is better investment than you ever made into real estate.
Absolutely. It was the best investment that we ever made. It paid us out the most. And I think a lot of people, especially entrepreneurs and investors are bad at this because they view assets, my money should go into assets that produce nothing else. The most important assets that you will ever invest in is the people around you.
That's right.
And I think that's a really, really important piece. So I suggest everyone to go look at it. Now, I know you are so busy. I don't want to take all your day. I could keep you on here and just get free tax advice forever. So for me and the audience, but I will not do that to you. So with that, hey, Tom, where can people go to learn more about you? We're talking about experts. How can people work with you, your firms? Like, where should people go?
Yeah, go to tfwadvisors.us, tax-free wealth advisors, tfwadvisors.us. We have a franchise of 13 CPA firms plus a corporate-owned firm, so 14 firms all over the country. We handle every state, just about every situation we're going to be able to handle, but we're very strategic. So if you just want tricks and tips, don't come to us. I'm going to tell you right now, go watch my YouTube videos.
Yeah.
If you want a real strategy, if you want a partner, then we're happy to talk to you about whether you fit as a client of TFW Advisors. We're pretty picky because we want people that we know we can help them be successful and we can be their best investment. That is our goal.
Tom, it was an honor having you on. I appreciate your generosity with the time. Thank you. Everybody go check out all your content, which is so overwhelmingly useful and powerful. We appreciate that, and reach out. Thanks for coming on.
Thank you.